Gary Wagner brings us to a close this week. Chart This is up next. Gary, thanks so much for joining us this Friday.
My pleasure. My pleasure as always.
Gary, last time we spoke, gold had hit a 6-week low. Now on Thursday, it has hit a 2-week high. So quite a turn of events here. What do you make of the recent movements we've seen in gold?
Yes, last time we talked, we were looking at the fact that gold had hit a 6-month low, but we also put it into perspective. And the perspective was that we had just really come off a $200 rally to the upside. And that upside had to have some sort of a correction. We saw just that. In fact, we saw it correct a little bit over 50%, not quite 61%, and then begin to move back up. In fact, on the last insert that we did, we talked about specific pivot points and specific things to look at to determine when, in fact, a market might turn around. Now, the fact that we're seeing gold hitting a 2-week high is also noteworthy, but to be expected. We're looking at the market right now in terms of our current forecast to run anywhere between, call it 1342 and 1362 on the high side. My belief is following then we will see one more corrective wave before we go into a fairly substantial rally in about 2 to 3 months.
Gary, let's look forward now to next week, where it will be a heavy data week with U.S. retail sales, consumer price index, the Philly Fed survey, and the Fed beige book all coming out. We also have the markets close next Friday and observance of Good Friday. Do you think it will be an impactful week for the gold market, Gary?
Next week, we do have a lot of economic data coming out, and that data will absolutely influence the market. But what I think we really want to be cognizant of is how the Fed reacts to the economic data coming out. Because if you recall, we had the release of the Fed minutes this week, and it seemed through those minutes that the members were very, very concerned with the effect that their tapering was having on the overall economy. And I'm talking about specifically the pressure that we have seen recently in the equities markets. So I think that they're walking on not so much eggshells, but they're walking very, very carefully, and they want to be very certain of each move they have. And the economic data, of course, is what will determine their next move.
So last time you were on, Gary, you helped our viewers find key pivot points in the gold market. What have you brought us today?
Yes, last time our insert really focused upon pivot points, or how we determine as a market comes down that has probably hit some support. We see a key reversal and it is probably headed back up. On today's insert, I want to talk about techniques and models we use to forecast where that upside rally might go to in terms of actual numbers, and give you an idea of how we came up with the numbers 1340 to 1360 as our current expectations of this next rally.
All right, Gary, on that note, let's get to your analysis today.
On today's insert, I want to pick up where we left off on our last show, talking about key pivot points, key reversals, and most importantly, the process of identification. As you know, for those who have been watching the Chart This series, it's not a single technique. Rather, my belief is that it is a combination of techniques that tends to give you the best results. For those that have been following the show over the last 6 months to even a year, know that one of the techniques that we have been incorporating is simply called an Andrews pitchfork. And we have an interesting scenario right now with the Andrews pitchfork, so I thought we might start with this particular chart. If you recall from about, a month and a half ago, I brought this chart out and I talked about the fact that genuinely this marketplace has stayed within this cascading channel line since we have been in this defined correction. And we've seen the market go from about 1800 all the way down to 1181 here on the low side. But the interesting thing about using cascading channel lines is that they will move over time. And so what you'll tend to see is that it's quite obvious we have real resistance at the top of this channel line, or what we call the zero mark. And as this market sold off, you can see that absolutely when it found support down at the 100% mark. Now realize that this pitchfork was created from 3 data points, and these 3 data points in terms of a timeline occurred in October of 2012, and in 2012 these cascading channel lines were already present. So the fact that we would see the market trade to the lows and then again to the highs is really a strong indication of how powerful this technique can be. Now, we pointed out that for the first time we saw the marketplace actually go and exceed that channel line. And to me, that was a major statement, because it gave us the possibility of a real breakout. And the last piece of technical information that I'm really looking for, so that we can confirm that we're not simply in a counter trend, meaning this bullish action that we've witnessed lately is a counter trend, we'll move back to the bear market we've been in, but rather it's a key reversal from a bear market to a bull market. There were a couple of techniques we used. The first technique, of course, was simply using a basic resistance line created from these highs here, drawing them across. In other words, we fixed these highs here, here, here. And so this breakout told us that we were truly witnessing something different. Now realize that's linear. When it came to the top of this channel, so to speak, my sense was that if it broke through here, that would be the final piece of technical evidence that said we are in a bull market. However, that wasn't to be the case, and the market absolutely corrected from that point. But what I want to point out to our chartist viewers today is, if you look at how it came to rest and found support at the bottom, or at this 23% retracement, and now appears to be moving back up to the zero prong, it's really showing us the strength of this particular study. Now, as I said, we absolutely use these studies in conjunction with other technical indicators. So the Andrews pitchfork by itself is compelling, but it doesn't give us all the information that we need. Another technique that I found to be extremely useful in finding and identifying key reversals or pivot points is a chart simply called the Japanese average chart, and that is one that we have used on many occasions. Now, the trick to using the Japanese average charts is realizing that they're averages, so they lag. When we're using weeklies like this, we're really lagging behind any kind of a trigger that we might get 2, 3, 4, 5 days prior to us getting triggers. But the techniques that we use, whether this is a weekly, a daily, a monthly chart, are the same with the Japanese average. And we've talked about it, but I really think that it really is a very powerful tool that's worth going over again. In essence, what a Japanese average chart does that's different than a standard candlestick chart is that on a standard candlestick chart, you're getting true opens and closes, and the top of the wick is the high, the bottom is the low. On a Japanese average chart, this body is not drawn from open to close, but rather each candle compares itself to the midpoint of the prior candle. A green candle simply means that it opened and closed above the midpoint of the prior candle. The absence of these lower wicks on the way up says that at no time during the trading activity of this candle or this week on a weekly chart did the price go into or below the midpoint of the prior candle. Red is exactly the opposite. In other words, what that's saying is it's opened and closed below the midpoint of the prior candle. Now, what you can see is obviously color coding, very easy to read. As long as you've got green candles, you're long. As long as you have red candles, you're short. However, it gets a little bit more complex than that, and there's more information available, because the beauty of this type of chart is it can give you a indication of the strength of a trend, whether that trend is waning or strengthening how robust it is. And you do that simply by body size. And then lastly, it's an amazing vehicle to look at pivot points. And what we do when we look for pivot points within a Japanese average chart is, as the market goes down, you'll notice that as it's in a full-blown downtrend, you have an absence of these upper wicks. As soon as you see your first wick come in, that gives you an indication that the trend is beginning to weaken. Look at how the body size compared to these bodies gets smaller. On the next candle, it's a larger bodied candle. However, you've got now tails on both sides. This last candle is not really giving you that much information because, again, you have lost this lower wick. But our pivotal candle, what we call our doji, doji is where the open and close are pretty much the same. This pivotal candle is what we look for because typically at a top or a bottom, you will get a very small bodied size candle that indicates that you've actually got that V, or what I like to term the key reversal, in that you hit your bottom and then you begin to trend higher. Now, if you look at this last trend up, it's not as clear on the top. You do have a smaller body candle, but we're not getting really that pivotal doji. You don't really get it here. What you do get is a change in color. So using a Japanese average chart, again, by itself is not enough to give you the information that I believe is necessary to be able to pinpoint these particular pivot points. So the next thing that we combine is actual candlesticks themselves. That's what we're looking at now. I've just converted the chart we've been looking at to a standard candlestick chart. On a standard candlestick chart, green candle means it opens and then closes higher. This body represents the range between the open and close. These upper wicks represent the range on a green candle between the close and the high and the open and the low. The reverse is true on the red candles. The beautiful thing about candlesticks is there are patterns that we look for in the market. For example, there's some very strong information that we get in these 3 weeks and these 3 candles. First and foremost, this particular candle type is called a hammer. And a hammer is a very interesting candle. It's found at the bottom of a market. And what is interesting about it is the fact that the bears are absolutely in control during this week. Lower close, red candle. Absolutely in control the following week. Now, during this week, as the market was trading down in this area, you had a red candle. Realize that changed as the candle was developing. But when you look at where the low is compared to where the body is, and that's the key. In other words, if the tail is a minimum of 2 to 3 times the length of the body, that's what's giving you that hammer characteristic. Then, of course, you get the confirming candle, which is a green candle, higher high and a higher low. But there's another candlestick pattern that is available right here, and that is that 3 river morning star variation that I've talked about. You can see that variation right here, which is simply the market going down, red, star, green. Now, because of time permitting, I want you to get all the information I can give you in terms of what systems we use to actually critique the market. And then lastly, we use a combination of Elliott wave as well as Fibonacci retracement. So we're putting candlesticks, Andrews pitchfork, Fibonacci retracement, Elliott wave all together to give us those roadmaps that we find so useful in the marketplace. Now, I am really excited about today's After the Show, because what we're going to do on After the Show this week is I'm going to disclose 3 particular patterns that have been really revealing and very accurate in able to call pivot points in the market. And that's what you'll be able to view as a member of the After the Show. Now, membership is absolutely free. And to view this week's bonus content, simply go to our website, goldforecast.com. You'll see Chart This After the Show. If you're not a member, go ahead and click this link to join. You'll see it says create your free account. Once you create your free account, you will see a series of new menu options that will allow you to view After the Show and take you to the various episodes that we've had. Of course, there will be a new episode up here tomorrow that will allow you to really see the 3 patterns that I am talking about. Again, using a combination of different technical indicators to pinpoint various pivot points and key reversal areas in the gold market.
Gary, as always, thank you so much.
It's always my pleasure to be here. I want to wish all of our Chart This viewers a great weekend and great trading next week. See you real soon. Bye-bye.
Same to you, Gary, and thank you for watching this edition of Chart This with Gary Wagner. Email us at newsfeedback@kitco.com, or you can follow us on Twitter at Daniela Camboni. Happy weekend, and thanks for watching.